In this module, we shift from theory to real-world AML work. You'll see how transaction monitoring actually generates alerts, how to spot meaningful red flags, and how to turn scattered data into a clear, defensible case decision. Customer due diligence sets the expected behavior line for a customer: who they are, what products they use, and which jurisdictions they touch. That baseline is your radar calibration. Monitoring then compares real activity against that expectation. For higher-risk customers, you tighten the rules with more granular scenarios, lower thresholds, and more frequent reviews. When activity spikes away from the baseline, escalation should be quicker and better documented, often moving toward a potential SAR. In AML transaction monitoring, rule-based and scenario-based approaches are two lenses on the same activity. Rule-based monitoring is binary and event-focused. If a cash deposit exceeds a defined threshold, it fires. Scenario-based monitoring looks for patterns over time, such as repeated smaller deposits that together resemble structuring. Rules are effective for clear regulatory breaches. Scenarios uncover subtle, cross-account behaviors. Both must be tuned by customer segment to avoid noise while still capturing real risk. Thresholds in transaction monitoring define the point where the system should start asking questions. You can set absolute thresholds, like any cash deposit over $10,000, or relative ones, like 3 times a customer's normal monthly activity. Higher-risk customers should have tighter thresholds, and this is not a one-off configuration. Teams need to regularly backtest alerts, measure false positives, and adjust for new typologies and changing risk appetite. Think of AML transaction monitoring as a funnel. Activity at the transaction, account, and customer level feeds into a scenario engine that applies rules, thresholds, and pattern logic. Typical triggers include large cash deposits, rapid in and out flows, or frequent cross-border wires. The system scores each event and routes it into high, medium, or low priority queues, so teams can focus on the riskiest cases first. Over time, banks refine these scenarios to reflect new typologies and reduce false positives. Rapid movement of funds is one of the strongest transactional signatures of money laundering. You're looking for money that rushes in and out so quickly it barely touches the sides. Velocity is high, but the end-of-day balance stays low. Funds are pushed to third parties or offshore accounts with weak or no business logic. When that pattern doesn't match the customer's stated profile or income, it strongly points to layering, mule activity, or an attempt to break the audit trail. Round dollar and structured activity is about engineering transactions to avoid automatic reporting. Instead of one large cash deposit that crosses a threshold, the customer breaks it into multiple deposits just under that limit, often in neat numbers like 9,000 or 9,900. These may be spread across branches, channels, or days, but still form a clear pattern. When you see repeated sub-threshold deposits with no convincing invoices, contracts, or payroll records, you should immediately consider possible structuring. Now compare a normal cross-border payment with a classic laundering pattern. In a healthy flow, money goes from exporter to importer with a clear business purpose. In a high-risk flow, funds bounce through multiple related accounts, often in different banks and countries, without a convincing commercial reason. Watch for repeated use of high-risk or sanctioned jurisdictions, convoluted routing via many intermediaries, frantic movements between internal accounts, and pass-through accounts that exist mainly to relay wires. In and out flows are classic conduit behavior. Large amounts come in, large amounts go out, and the balance keeps dropping back near zero. That's not how most legitimate customers operate. They usually retain some working capital. Red flags stack up when this throughput doesn't match any real business activity. No payroll, rent, tax, or supplier payments. Counterparties look random, with no link to the customer's stated industry or geography. And when you ask for justification, explanations are vague and documents are missing. Taken together, that strongly suggests potential layering or money laundering activity. Alert triage is the first filter, so the team spends time on the right alerts. Start by validating basic data. Does the customer exist, and are dates, amounts, and rule triggers correct? Next, check whether this looks like a classic false positive, a known system glitch, or a pattern that's already been cleared as benign. Then compare the activity with the customer's expected profile. Based on those checks, you either close, park for monitoring, or escalate for deeper investigation. Information gathering is where an alert becomes a real investigation. Begin with internal data: account statements, transaction details, narrative fields, KYC and EDD files, and any prior alerts or customer contacts. That shows what the customer is doing with your institution. Then widen the lens with external sources: open source intelligence, adverse media, corporate registries, beneficial ownership tools, and sanctions or watch lists. Strong investigations deliberately cross-check internal and external information before deciding what happens next. Narrative building is where your investigation turns into a coherent story. Start with the 5 W's and how: who is involved, what happened, when and where it occurred, how it was done, and why it's suspicious. Then tighten the story with precise facts: amounts, dates, counterparties, and patterns. Next, connect what you see to known red flags or typologies. Finally, state a clear, evidence-based risk assessment that logically follows from the narrative. Disposition is the decision point. What do we do with this case now? If the activity is fully explained and fits the customer's known profile, you can close it, but you must record why. If doubts remain, yet you lack clear grounds for suspicion, you keep the relationship and transactions under closer monitoring. If you have reasonable grounds to suspect money laundering, terrorist financing, fraud, or sanctions issues, you escalate, update the risk rating, and initiate an SAR or STR. To stitch everything together, think of a single case. You begin with the customer's stated profile and expected activity. A monitoring rule then fires, turning normal data into a signal. You test that signal through investigation, using records, open sources, and critical thinking to build a narrative. Finally, you decide: document and close, or escalate and report. That profile signal investigation action loop is the heart of practical AML work.